Hello, everyone, and welcome to the LizzardTrader webinar here today. Let's just make a couple of adjustments here on my end. I need to make sure that everything is set up correctly before we get going here. All right, it's looking good here. Everything should be set and ready to go. So the presentation today will be about 60 minutes, perhaps a bit less, maybe a little bit more, depending on how I do on pacing the slides here. I will not take questions during the presentation today. I have a lot of material to cover, so I will focus on the slides here and try to stay within the time limit that we have set for today. So if you do have any questions that come up along the way here, please just go ahead and type them into the chat box, and I will get back to you via email after the webinar. So for those of you who are not familiar with the LizzardTrader team, that's me to the left. I am Chris Lassen. I'm the co-founder and CEO of LizzardTrader. I have a background in system trading from a previous company, CentiTrade, which specialized in reading market sentiment from financial news, a automated artificial intelligence algorithm that we had created for that, and we sold that data to institutional investors and helped them integrate this in algorithmic trading models and managed futures products. And then I sold that company about 1.5 years ago, and I started up LizzardTrader here with Harry, who should be familiar to many of you. He is also known as Fat Tails over at the Big Mike Trading Forum, or what is these days called futures.io. And he is, of course, very well known throughout the NinjaTrader community. He has programmed some of the most downloaded indicators for the platform, including the tools that we will present here today. Speaking of today, let's have a quick look at the outline for this webinar. I am going to talk about session indicators here today, which is what we usually call leading indicators, and those are the pivot levels and the volume weighted average price specifically. And then I'm going to show them how to use them in a trend filter today, and I'll also go over how you can use these in with trading generally. So if you're already familiar with them, then you'll have to bear with me for the first 20 or so minutes here as I go along explaining the general gist of what session indicators are all about. All right, I will also have a tool for timing your entries here today, namely the zero lag oscillator. And in that regard, I will look at some simple rules for creating trading setups, basically going over the type of conditions that you want to see before you enter the market. And towards the end of the webinar here today, you will then have a trading strategy, a good overview of our trading strategy that we use with the session indicators and the zero lag oscillator. And there will also be a special promotion with a deep discount on some of our indicators here today, so including a couple of special bonuses. So you might want to make sure that you stick around until the end for that. Some good stuff coming up for you guys, so stay tuned. All right, so before we get going here today, I will add our customary disclaimer here that's stating that trading is associated with considerable risk. So please make sure that you understand that, and keep in mind that the results from the trading setups and the trading strategy that we're going over here today are hypothetical and not based on actual performance. All right, so let's get started. First of all, what we call session indicators, as I said, are better known as leading indicators. They are leading because they tell us areas where we're likely to see market action before it actually happens. And that's really important because you can then position yourselves for trades with a superior risk-reward ratio. So 90% of market volume is institutional, so their view on the market is very different from what we as day traders see, obviously, and their order books are huge, so their buy and sell orders will be parked around these predetermined price levels, and by that I mean pivot levels and previous volume weighted average levels, because they know simply there will be a lot of buyers and sellers positioned in those areas, and there will be liquidity here. So yeah, these are price levels that are commonly agreed meeting points in the marketplace where buyers and sellers will transact. And yeah, all you have to do is take a look at a chart, and you will see that pretty quickly later on in the webinar here today. All right, so yeah, this is a important point, these meeting points, because they go to the very core of what technical trading is all about. It is about finding areas where enough traders will react in a coordinated way when looking at certain chart patterns and support and resistance levels. So that will only happen if we're talking about price levels that are well known throughout the trading community, and that are objective, so that they will be the same for everyone. And that's really unique about the session pivot and VWAP levels. They are objective, they are the same for everyone, no matter what kind of chart type or bar type you use. So professional investors know where to buy and sell in these areas, and they position themselves accordingly. So to start off with here, I will just do a quick recap or introduction, depending on where you are, on leading indicators and how and when to use them. So the first one out is the volume weighted average price. That is the volume weighted arithmetical mean of all transactions that take place over a defined period. So you can calculate it for pretty much all instruments as long as you have price and volume data available. So institutional traders use this as a tool to reduce execution costs. So I just said that 90% of market volume comes from institutional activity, and recently there was a survey out there of institutional investors, and 60% of them, or almost 60% of them, said that they relied on algorithms to achieve the volume weighted average price or better. So I think we can all agree that it makes sense to know where the VWAP is and how to position yourself when the price approach this level, because this is where institutional traders will very likely participate in the market action. So in the following here, I will just go over a few pre-cut slides that will show you how this all works. I will get to some more recent charts towards the end of the webinar, but for now, I just want everyone to understand what I'm trying to explain here. So I found some situations and charts that are really good examples of what I mean by this. So here is a daily VWAP chart of the ES contract, the S&P 500 E-mini. This is a 15-minute chart, and the VWAP in a daily VWAP is anchored at the start of the session for which we record the transaction here. So the calculation will start with the first transaction of the current day, and it ends with the last transaction prior to market close. And during the day here, the VWAP will gradually stabilize and it will put on more weight. And as it does, it becomes more reliable as a technical trading tool. So what you want to really pay attention to here is the first standard deviation bands of the volume weighted average price. So that is what we define as market value. And the reason for that is that statistically 70% of all transactions during a day will take place here, and so you're very likely to catch new trends early on in this area. So this is really where you want to look for your trading setups within one standard deviation of the volume weighted average price. So obviously we know that there will be significant price action when the market is in this level, because a lot of institutional traders will be looking to buy or sell, and when there is institutional participation, obviously the market is more likely to move. So that will in turn make it easier for us to spot entry and exit points with a favorable risk reward profile. So if we're in a downtrend like we see here at the open on this particular day, there was a down push and then a retracement back up to the VWAP, and so that is a really good area to enter a short position. And we're then taking a so-called inside-out trade, and the exit is then sought towards the second standard deviation, because this is where statistically we'll have very few of all transactions will actually close outside this area. So it's about 5% using the bell curve for this. So yeah, this is the area where you're very likely to see oversold conditions. And sure enough, the market turned back and established itself above the VWAP, and then retraced back down to the volume weighted average price and presented us with a long opportunity here. And again, the exit towards the second standard deviation to the upside. And we also have previous VWAP levels here that are really important meeting points for buyers and sellers, and you definitely want to make sure where these levels are, and that you're trading to the right side of these levels. Here we see the red staple line here towards the bottom is the volume weighted average price of 3 days ago, and you see it worked as support here. And to the upper part of the chart we have yesterday's VWAP and the VWAP of 2 days ago, and that provided some added resistance here several times throughout the session. And yeah, that's basically a quick intro to what the volume weighted average price is all about. And now I'll show how we can use this as a trend filter in the following. So when we're talking about trends, we want to distinguish between the near, intermediate, and major trends. And what we're looking for here in the following is to align the major with the intermediate trend perspective, and then we're using the near-term trend to time our entries, and that's normally the correction into the intermediate and major, and that will provide us with a good entry point. But before we get to that, I will just show how we use this to establish the VWAP, to establish the major trend. And for that, we use a moving window of the accumulated volume weighted average price over the last 3 days is what we have here. And we can then compare where the price was trading today compared with the 3-day rolling value or the 3-day rolling volume weighted average price. So here we see a 30-minute chart of the ES again, the S&P 500 E-mini contract. And as you see here, the price is broken down below the 3-day rolling average, indicating a new downtrend. So the price is retracing back up towards the value area here, and that is then a good area to find short entry points. What we also have in this rolling VWAP is a comparison between where the 3-day rolling average was located 1 and 2 days ago. So here we have where the rolling average was yesterday, and here we have the rolling average of 2 days ago. And what we get by comparing those levels is a range. So this was the range 2 days ago, and obviously if you have a wide range, then it shows a strong momentum. And then if we have a comparatively smaller range directly thereafter, then we have a weakening momentum. So this clearly smaller range than the previous one, coupled with the fact that the price is breaking through the downside of both this range level and the VWAP, is pointing to a downtrend in this particular situation here. So good short entries towards the retracement of the VWAP level here, the 3-day rolling VWAP. Okay, so that's the first. And the second session indicator that I'm talking about here today is the pivot calculation. So many of you are familiar with this, of course. So I'll just do a quick intro on what the session pivot or the pivot calculation is all about. A lot of traders are looking at these levels, and they're using them as pretty much a self-fulfilling prophecy. They have a predefined idea of what to do when the market interact with these levels. So there will be a lot of dormant orders in here, and you want to make sure that you align yourself in a way that statistically puts the odds on your side of being at the right side of support and resistance. And what we're talking about here is a simple range calculation to find the buy and sell levels throughout the trading day. So it's not a big secret here, and it's the high and the low and the close divided by 3, and then we have added a few other calculations accounting for the volatility of last session to create these support and resistance levels above and below the pivot that we see here. So as I said, these levels have turned into something of self-fulfilling prophecies, and we're very likely to see coordinated buying and selling in these areas. So in this particular example, we have the price opening below the first support level, and then going straight into the second support level, testing that, and then bouncing back to the first support level from below, which of course means that it's resistance. If we're coming in on a level like this from below, it's always resistance. And then the price is gravitating towards the pivot range, only makes it halfway. In this indicator, we have a function to point out the mid-levels for you. So this is the mid-level between the pivot, the main pivot, and the first support level. And you can see there's a meaningful resistance in this area. And so the price basically gravitates back down to the second support level. And that is very often the low of the day, of the session. So conversely, the second resistance level will a lot of times be the high of the day. So the general gist of this is then, of course, that you want to buy support and sell resistance when you're moving into these levels, and aligning yourself with institutional investors that way, because that's statistically where they will take profits and go bargain hunting. So that will significantly improve your chances of success if you keep this very simple rule here in mind as you move forward. Okay, so let's have a look at how we use this as a trend filter. We're then using a rolling pivot calculation that was suggested by the eminent Mark Fisher in his book, The Logical Trader. So you then take the highest high and the lowest low of the last 3 days and the settlement of the current regular session. And yeah, if the market is trading above the 3-day rolling pivot, we see it here, this staple line in red, then you're in an uptrend. And if it's trading below it, if you close below this red staple line, then you're in a downtrend. So the principle here is the same as for the regular pivots. Ideal trade entry is in the direction of the major trend when the market is retracing down towards the value area, as represented by the 3-day rolling pivot range here. So we see here two retracements into the pivot range in a long scenario, and those provided some very nice entry opportunities here. If you're not familiar with what I mean by range, this is the pivot range. It's comprised of 3 pivots. The central pivot, which is the easiest range calculation that there is. You just take the high and the low and divide by 2, and then you have the central pivot. And then you have the main pivot, which is what I just explained, the high and the low and the close. So you're giving more weight to the end of the session where the market closed. And then we have the directional pivot, which is basically just a mirroring of the distance between the central pivot and the main pivot, but in the direction of where the momentum was taking us in the last session. So it's showing in which direction the market was moving. Okay, so yeah, you see here also the same example as I had with the rolling VWAP. We are trading below the pivot range here, and these retracements going back into this area give us some really sweet short entry points here. So why do we care about using the rolling pivots for trend analysis? Well, it's because what most people use for this are lagging indicators, and they of course will tell you what's already happened a while back. So whatever it is telling you, it does have limited value in the sense that the information is dated. So that specifically relates to the calculation period, or the bar period, because these indicators, they will tell you different stories depending on the look back period that you use. So you can have a 200 moving average, or 100 or 50. And another issue with that is that you're referencing data points or price data that is in the night session. And the night session, of course, has a lot less volume, and that's what I wrote about in the most recent blog post, which you can have a look at Listatrader, at the Listatrader blog. So basically the issue here is the difference. This is the ES again, the S&P 500 E-mini contract, and you see here, this is the regular session, so there's some really heavy volume on this. And then we have the Asian and the European session in this area. So this is obviously a local market with the local stocks. The underlying equities here are traded in this time window. And so if you're using a trend filter, here we have the ADX up on here with it's using a six period. So if you're measuring the trend here, it is still referencing these very low volume bars down here that was moving in a completely different direction, and might not be very accurate for you to determine the trend based on this information here. So one way around that, of course, is to choose a different session template. So you can only choose to have the regular session information on here, and that of course will then lead to these big price gaps here, because there is stuff happening overnight here, obviously, and that is now a different problem for this look back period here. So that's also not what we want to do here. And there's a lot of these big gaps. So that's really not the way to go when you're using this lagging indicator. So what we can do instead is to isolate with the session pivots. We can isolate this price data here and still work with the entire material of price data that we have, but we focus on determining the trend based on this high volume data. And I can show you now in the ES chart here how we do this. So we have here a this is showing all the price data that we have available. Also, we still have the European and the Asian session in here, but the indicator is built so that you can isolate the data specifically for the regular session, and that's really neat, of course, because then we have the footprint of the institutional investors that are active. So as you see here, we can isolate the RTH session, the regular session here. We can also go with the entire session price data if we choose to, but I think we have seen that this is really an instrument that you want to focus on the high volume data when you're determining the trend. So again, here we have the prices trading above mostly the rolling pivot. A couple of instances here where it's dipping below, and there's some false signals because of that. Of course, that's not possible to avoid that. Here we have the other version of it, which is for the crude, and here we have a rolling VWAP, and you see the price is trading above for the most of the time here, and for an extended period before this time we were in an uptrend. So it's quite an accurate trend filter. We have a few hiccups here, and then it breaks to the downside of this, and then consolidating and then making it back up. But you can see here we definitely were in a downtrend for 2 days here, and so that was accurate at the time. So what we can do here now is to just go ahead and look at some trade entries for these, and let's have a look at crude first. And what we'll look at is how to time our entries based on this information. So you've seen the major trend in the rolling pivot and the rolling VWAP charts, and now we'll look at how we align that with the intermediate trend. The intermediate trend is detected by our indicator, the zero lag oscillator. So you see the oscillator here has moved above the zero line, and that is telling us that there is an intermediate uptrend. And so in this case, we have the major trend and the intermediate trend aligned with one another. And so in that case, we're looking for long setups. And what we're seeing here is these white bars down here, and they are indicating a short-term oversold in this uptrend. So this is the setup that we're looking for. We're looking for a short-term oversold in an uptrend, and then we're looking for a sign that the buyers are taking advantage of these short-term lower prices. And if there is a bar that closes above these setup bars, these short-term oversold bars, then it's a sign that the buyers are coming back to the table and that the uptrend will continue. And that's when we get our signal here. So this is what we call a upthrust bar right here, with a close above the high of the setup bar. That's an upthrust bar. So if that's the case, then we want to define our risk first, of course, and the stop for these signals is set below the low of the signal bar or the setup bar, whichever is lowest. So here we have the stop. And then we want to look at what's the next logical level of resistance here. And what we see here is resistance level 4 and resistance level 3. And then we have the 2-day volume weighted average price of 2 days ago down here. And so the next logical level of the resistance in the direction of the trend is this area up here. So this line here is going to be our target. And what I like to do is to take trades with a risk-reward ratio of 1 to 2 or better. So this here is the risk on our trade. And then I will just quick and dirty do a comparison between this risk and see how far along I get to the next resistance level. And as you see here, this is about 1 to 2.5 risk reward. So this is my reward on top of the distance from my entry point to the next logical level of resistance. And as you see here, this worked out quite nicely in this case. So that's how we define the risk-reward ratio on the long trade. And then I can show I think I had a short example here in the ES. This is a false signal, of course. As you see, we get stopped out fairly quickly, but in my mind, there's nothing wrong about taking this signal. We have a downtrend in the or maybe one of these shorter downtrends that we saw in the bigger charts. And what we see here is the histogram dropping below the 0 line, and then we take the first retracement into this new downtrend, and that is a short-term overbought. And the overbought, short-term overbought, is detected by the fast stochastics, and it is showing us here these yellow bars, which is signaling the setup. And so much in the same way as for the long signals, we set the stop just above the high of the signal bar or the setup bar, whichever is highest, and then the entry is taken right here at the close of the down thrust bar. And as you see here, we are stopped out very quickly. But the big advantage of this setup is that you really you know very quickly if you're at the wrong side of the market, and you can move on fairly quickly from there. It's really also quite clear what the risk is here. So we went in here at 202, and here we had 203. So yeah, 4 or 5 tick risk on this. So a very tight stop on this. And okay, so we're stopped out, and it's time to move on and look for the next opportunity. And here we have another false signal, unfortunately. But again, you see the we found out very quickly that we're on the wrong side, and we can move on from that. Again, the risk is very moderate here. So we have here 750, and here we have 850. So 1 point. Okay, big deal. And then we have something down here. Okay, and now it looks like a better signal, but again, you want to evaluate the risk-reward ratio that you have on these trades. Another thing that's interesting about this signal is that the zero lag in fact, also allows you to play around with the entry conditions a little bit. So you see we have normally only signals when you have these overbought or oversold signals, so yellow or white bars. And here you see a WP signal. That's a weak pyramiding signal. So a pyramid signal is it's not the first retracement. So the first retracement is up here, which is a weak retracement signal. And what this is allowing you is to pause one bar before you see the down thrust bar. So we have yellow, salmon, and then a signal bar, down thrust bar. And as you see here, this is going to the midpoint between the first support and the pivot level here. This trade here was filtered out because it was pretty much a one-to-one. It doesn't make it to 1-to-2. All right, so let's see if we had some other examples here. This one. Again, we have a weak signal here. This is again what I just mentioned. Normally, you want to have these white bars here immediately cancel out by a upthrust bar. And as you see here, this bar here is not white, but there is clearly a selling pressure in here. And so what the weak retracement signal will allow is detecting selling pressure, but it's not the oversold as detected by the fast stochastic. So it's allowing for a signal on this one. And what we have here is a very nice trade. And in this case, we're looking at the yesterday's high as the next level of resistance. In this case, we're not using the midpoint because it's not in confluence with other price points. So we're doing a risk analysis based on the lowest low of the setup bar, which is here. Let's see, at 1775 and 1650, so 5 ticks on this. And then we have 2275 as our target. And I think we'll see that this is clearly a trade which is well beyond the 1-to-2 risk reward ratio. So we have almost a 1-to-4 on this. All right, I think that's of course by trailing this, you can get a very, very nice cash in on this one. The first resistance level is up here. You see there is a consolidation here between yesterday's high and resistance level, first resistance level here, and then it breaks through that level after a short consolidation as well. So as you can see, again and again, there is buyers and sellers located in these areas, and that's why it's so important to be aware of where these price levels are. So I'm also trading this for the euro, but I think that is it for the examples today. I think I will move on to the presentation here again, just to hammer home the point of why we are using these predefined price levels, the session indicators. It's basically to avoid this type of situation. So when you're using them, you're basically checking that you're not going straight into any of these major landmark support and resistance levels. And the reason is, of course, that when you're moving into or trading directly against one of those levels, you're very likely to see a pullback or a bounce, and that typically is when you get stopped out within a minute or two after having entered your trade. And that's very, very bitter, and something that I think we all agree that we want to avoid. That it's very damaging for the psychological health of the trader to have that type of experience. So what we're doing here is really to filter the trades by saying that if we're moving within a certain distance of landmark resistance, then we only look for short setups, or we want to exit our long positions. And if we're going straight into support, then we're only looking at taking longs or get out of our short trades. So similar to choosing poker hands, you don't want to play every hand that you're dealt, because if you do, you have much lower probability of winning. So it's simply about assessing your odds here. You want to play your good hands and avoid situations when you have simply bad odds at succeeding. And trading against these institutional price benchmarks is certainly that type of situation. So it's only when the statistical percentages are skewed in your favor that you want to go for it. And so then basically we focus on these setups that have a favorable risk-reward profile, and that means looking at something of 1 to 2 or better. So ideally, if you risk, let's say, 150 per trade, and you limit yourself to 2 stops per day, then your max daily loss is 300. And so to offset this potential, you want your winning days to be larger than 300, obviously. So the point is, the risk reward winning trade can make up for 2 or 3 losing trades. All right, so I know there's been a lot of information here, and I just want to summarize things here quickly before we move on into the last section of the webinar. So the idea here is really to pay attention to where the daily VWAP is. So we want to be within the first standard deviation of the volume weighted average price, because this is where we anticipate institutional participation in the market, and where we're likely to catch new trends early on, and where we're likely to see the prices move. And then we use the zero lag oscillator to find these retracements and to identify the intermediate trend, and then we confirm that with the major trend as defined by these rolling pivots and the rolling VWAPs. And if I can just go back into the chart here, I will show how this actually looks, this template. For those of you who are not familiar with Bloodhound, this should be interesting, because I've basically defined everything that we talked about so far, these retracement signals by the zero lag are located up here, and then we have another solver, another rule here that is saying the price has to be within the first standard deviation of the VWAP. And then here we have a solver that says so you cannot go against pivot levels or previous VWAP levels. And then we have these rolling pivot and VWAPs down here, which are our trend filters. And then I have some time filters in here as well to define which times I'm trading this in European and US time. So I have 2 time session solvers in here to specify when this strategy should be trading and when not. Okay, and then of course there is the review of the risk reward. So I measure always the distance between my stop and the next anticipated possible resistance or support level, where in which direction the price is moving. So as I said, this is a system that I'm trading for crude, for the E-mini contracts, and for the Euro Forex future contract, the 6E. And yeah, here we have the conditions again. And yeah, I hope you have a good idea by now of why it makes sense to work with these concepts. A lot of people out there are looking for the latest holy grail or some secret indicator to give them an edge, but as I said, that's not what technical trading is about. You want to find these objective price levels that have widespread use, and by looking at what institutional traders use as price reference points, you have a much better idea of what the market will likely do next, and you can really learn how to read the market by using these tools. And that's what the VWAP and the pivot levels are all about. And then we use the zero lag oscillator to time our entries and to control the risk. All right, so here's the deal. If you decide that this is something that you're interested in, we have a special going on our indicator package and Bloodhound, because we think it really makes sense to use this in a system setting. So we actually make less of a profit on this by selling it with Bloodhound, but we think it's a really good complementary offer when you show everything how to use it, and then you give the customers a opportunity to purchase a plug-and-play product, so you can basically get all the indicators here, and you get the Bloodhound plus strategy templates so that you can start using this right away. So the indicator packages is in and of themselves an amazing value. So you have the daily volume weighted average price that I've shown you here today, plus the pivot calculations. You then also have weekly and monthly and the rolling pivots that I've shown you. And yeah, these are just really professional grade indicators that can help you align your trades with institutional investors that account for some 90% of trading volume. So it definitely makes sense to get a heads up on when and where they're likely to enter and exit the market. So with these indicators, you get Bloodhound for free today. Normally it's $4.95 to get Bloodhound, but if you get this package here today, you get our indicators, and you get Bloodhound for free with it. And we also have some other bonuses here today. And the first bonus is the session template handbook, which is very useful when you're working with session indicators. It will show you how to isolate these regular sessions and night sessions and evening sessions where institutional traders are or are not active. And so that is especially useful when you're working with session pivots, because you definitely want to work with the right pivot levels and chart settings when you're looking at a market which is dominated by local traders with a strong tradition for using floor pivots to determine their buy and sell levels. All right, so the second bonus is the strategy templates that I've shown you here today. So they're not the same for all instruments. Each market has its signature, so I've made some adaptations to the different markets. So the Forex Euro strategy is a little bit different than the one for crude, and the crude is a little bit different from the ES. They're very similar, but there are some important differences from each strategy. So in effect, there are 3 strategy templates for this setup. All right, so normally the price for all of this is just shy of $1,600. So what we've done here is to put everything that we just talked about, everything that we just covered, into one package that can help you implement this. And as I said, for those of you that don't have Bloodhound already, you get it pretty much for free with this offer here today. We have a total price of $9.95, and that's almost $600 off the normal price. And yeah, we have these sweet bonuses in here as well, which I just mentioned. If you are already a Bloodhound customer and you own Bloodhound, then you get an additional $300 off. So a total of $695 for the indicator package here, the strategy templates, and the session template handbook. And yeah, the bonuses are just up for a limited time here. So if this is something that you're interested in, you can of course buy the indicators anytime at our website, but we only offer the bonuses with these webinars. So if you're interested in this, you need to act on it because this is not going to be up for very long. I'm absolutely convinced that this will make you a more structured and disciplined about how you think about trading setups and execution. And hopefully it will also make you a more patient trader. So I think that is pretty much it, what I had for covered for today. As I said, it is a pretty amazing value. Not only do you get the session indicators that I talked about, we also have some things that I did not get to talk about here today. I don't want to overload with all new information, but there is basically also a very interesting indicator in here, which is the range weighted average price, which we use for instruments that have limited or lacking volume information, which is commonly the case for Forex products. And so the strategy that we have for the euro, we're using this range weighted average price, which is substituting the volume information. As you know, there is no centrally located exchange for the Forex contract, so that means there's no really comprehensive way of knowing where and how many contracts were traded when, and that's that can be a problem. But the range weighted average price calculation is a very good substitute for that. So in addition, we're using the Jackson zones as a part of this strategy, which is a variation of the traditional pivot level calculation with the adjacent Fibonacci ranges. So if you're using Fibonacci, that's a really nice add-on here as well. But I see we're coming up towards the end of our allotted time here today. Yeah, just one of the benefits that I really have from this is that I can have email notifications when there is a setup coming into these strategies, and this way I can I don't have to sit glued in front of my PC waiting for something to happen all day, and it also prevents me from over trading. So I get an email when I have a signal, and then I go to my computer and I see if it's something that I'm interested in participating in, and then that's the end of it. So a lot more efficient in terms of how I spend my time. You can of course automate this as well. You can allow Bloodhound to take positions for you, and yeah, some really really cool stuff here in this this special offer here. So head on over and take advantage of it while it's still here. So just to round things off here, I will talk a little bit about the lizard. Most of the time, it looks like they're just sitting around, not doing much, but in reality, they're listening and looking and waiting patiently, with emphasis on patiently, for an opportunity to grab what's right in front of them. So they've used this simple survival technique for millions of years, and as traders, there is definitely something that you can learn from this, and that is to have a clear and simple strategy and to wait patiently for the opportunities to come your way. You don't want to be out there chasing the market. You want the opportunities come your way. And yeah, the advantage by what I've showed you here today is that it is a approach which is easy to understand and execute. As a listed trader, you are hanging out in the VWAP value zone in the first standard deviation area from the volume weighted average price, and you're waiting for these major and intermediate trends to align. And once the zero lag oscillator detects a near-term retracement into these major trends, and we have a price action confirmation, you simply check your risk-reward ratio and enter with confidence if it's to your liking. So again, these are really high-quality tools at a incredible value. So time for you to head over to our offer page here and take advantage of this. And I really appreciate you taking the time to participate here today. I know you all have busy schedules, so with that, I think I would like to wrap this up. And yeah, as I said, I'm happy to answer any questions. So if you haven't typed them into the chat box here, then please do so, or you can drop me a line at info@listedtrader.com as well. I can get in touch with you if you get in touch with me through the contact form as well over at listedtrader.com. Thanks again for checking in. I hope it's been of value to everyone, and I look forward to welcoming you as a listed trader very soon. All right, thanks again. Have a wonderful rest of the day, and I'll see you soon. Take care. Bye-bye.